Thanks for coming out this morning. Again, my name is Joe DeMarco. I'm a partner in my own practice, DeMarco Sciaccotta, LLP. We've been around 2 years. We all came out of a bigger firm, and we just saw a niche for a smaller boutique firm in the small to mid-sized, privately held company market. I mean, first and foremost, fees drive a lot of decisions in this economy. We noted that, and we're very flexible with clients. We work with them more as trusted advisors. So yeah, it's been going really well. So I wanted to talk sort of about startups, and then as you grow, what to look for, because a lot of people in here probably already established companies, but you may know somebody that is starting a company. And I just had it actually a few days ago. We picked up a new freight brokerage client. And the first question that they asked me was, what do we set up as? What do we do? They don't even know. And I'm definitely not an attorney by any means, but I get the question all the time, because as the CPA, they need to know, okay, well, if we set up, what do we do for tax purposes? How do we allocate money, so on and so forth. So the first thing I wanted to talk about was sort of just what type of business you should be, because some of you may already be an LLC or an S Corp. Others, like I said, you may be thinking of starting a business. So these are typically the two entity structures that at least I see most often with small businesses when they're ready to set up a business. It's either an LLC or an S Corp. And what an LLC, a lot of people don't really have an understanding of what an LLC is. And I just wanted to point out some of the key features of an LLC. So if you know someone that's starting one, you can sound more intelligent. An LLC basically is similar to a corporation, okay, where owners obviously have limited personal liability. So if someone falls in your property or something happens, they can only go after the assets in the LLC, technically. I know attorneys can do a lot of stuff, but I mean, that's the point of an LLC. So all debts, actions, everything else stick in the LLC. Also, LLCs, they default to a partnership. So basically, when you set up an LLC, it's going to act as a partnership, okay? Which means there's a lot of flexibility. So if you start the business and you have one partner and you want to grow, right? An LLC as a partnership really enables you to add a partner very easily. If you want to buy a partner out, if something, God forbid, happens and the partner passes away, it's very easy to get partners in and out of an LLC, okay? And then the last thing is that the owners, and I'm saying partners, but technically in an LLC they're called members. So you may have that term thrown around when you're talking to someone about an LLC, but that's what the proper term is for an LLC owner. They're called members, and they could literally be anybody. They could be individuals, they could be corps, they could be other LLCs owning in that LLC that you own. That's what makes it so attractive, is that an LLC has multiple means of ownership. The other thing I get all the time, and I got a blank stare, like I said, when we were talking to this new client, is when you're an LLC, you don't, as an owner, you don't take salary. And it's an odd concept, and people don't really understand it. But if you're an owner in an LLC and you want to take cash out of your business, you either have to code it, and I see this a lot when we pick up new business, it's done wrong, but it's either coded on your accounting records as a draw or as a guaranteed payment. So if you're an owner in an LLC and you've been taking salary through like a W-2 or something like that, you're doing something wrong. So just as a heads up, if you have any clients as well. And then the last thing on an LLC, there is an operating agreement that should be done up front when you start the business. And basically, that's different than setting up a corporation or an S Corp. It's an operating agreement, and attorneys will help you with this, but an operating agreement basically lists the terms of how the LLC is going to function. So, and I think it's so smart, because there's so many times you get into business with somebody, and then 2 years down the road, they're not doing what they say they should be doing, and you want to get them out, or you want to change the profit loss allocation, so on and so forth. Everything is outlined in an operating agreement, and it could be tweaked as you move along with the business, as you grow. But that's an important feature of an LLC as well. Okay, now S Corps. S Corps are very similar to LLCs. Same concept. So an S Corp, if you make money, it passes through to the owners individually. Okay. So as an LLC, if you have $100,000, you'll get a K1 if it's taxable income. You'll get a K1 through an LLC, as a partnership return and as an S Corp. So that's how you get taxed. Everything gets recorded for tax purposes on your 1040, okay? And then, as I was saying, LLCs, they're fashionable now. A lot of people like them because of the flexibility. S Corps, I see a lot of that as well. The only issue with S Corps are their restrictions. You can't do a lot of things. And the two areas that I see a lot with clients are the allocation of distributions, which all that means is that if you want to take money out of your business, okay, as I was saying, with an LLC, you either take it out as a draw, you just take your money out and you record it as a draw, or it's a guaranteed payment. With an S Corp, you could take salary. So S Corp owners actually do take salary. It's actually being scrutinized by the IRS now that the IRS is wanting S Corp owners to take what they call reasonable compensation. If you don't, it's a big time red flag. So what happens is, in an S Corp, the allocation of distributions are very important because if you own a business and it's 50-50 with someone and you're an S Corporation, and say the 50% owner is just not doing anything, they're not adding any value to the business at all, and you want to take $50,000 out of the business. You have $50,000 in cash and you're like, okay, we're going to take a distribution. S Corp rules disallow you to say, okay, as the guy bringing in all the business, I'm going to take $40,000 of this. And this other guy that I'm partners with, or is the other shareholder and I own the company with, he's going to take 10. Can't do it. It has to follow the ownership percentages. So anytime you take a distribution out of basically out of an S Corp, it has to follow the ownership percentages. If it doesn't, you're putting up a red flag and you may lose your S Corp election, which I'll get into in a second. So like I said, distributions have to be paid in accordance with shareholder percentages. Huge area. A lot of people don't do that. We have a client that, we just saw, didn't do it. And, you're just asking if you get audited for the IRS to revoke your S Corp election. And I'll get into that in a second. And like I said, shareholders in an S Corp, you basically can't, the only ownership you can have in an S Corp basically is generally an individual. You can't be another corporation, CRS. You can't be an LLC with multiple members. So there are restrictions, like I said, with an S Corp that, a lot of people move to an LLC just because of that, okay? And then the last thing I want to point out in an S Corp is, and I see this mistake a lot, is you actually have to file an election to become an S Corp. It's Form 2553, and typically, your accountant will help you or your attorney will help you, but I just wanted to bring it up because a lot of clients are always confused about it. But in this simple example, basically, the requirement is you have to do it. You have to do it within a 75-day period after the beginning of the tax year. The election is to take effect. So and that's confusing. So I laid out an example, and it's very simple if you look at it. If you started your business on January 7th, you're a brand new business, and that's when you started. You have 75 days from January 7th to file this election to become an S Corp from a C Corp. Okay? So regardless, if you say, I want to be an S Corp, you have to file this election. If you don't, you'll remain a C Corp. Okay? And that 75 days in that example, if you file this form between January 7th and March 21st, which is 75 days, you will be an S Corp for 2011. That's the year that it pertains to. Okay? If you do it before January 7th, the S Corp isn't even valid. So you just wasted time. And if you do it after March 21st, which is that 75-day period, your S Corp election isn't valid until the following year. And that's where we get a lot of clients that always say to us, well, I filed my S Corp election, why am I not an S Corp? And it typically falls under this rule, and they filed it on June 30th, and it's like you were too late. So it's a big rule, because typically the IRS allows you time after the year to do stuff. An S Corp election, you have to do it during the year to qualify. Okay, so all that stuff, LLC and S Corps, that's for startups again, and some of you may not even apply. The next section I wanted to talk about is tracking your financial information, because I see this a lot too with small businesses, and picking the proper software package. Typically people pick QuickBooks. It's the easiest one to use when you're starting out, even when you're growing. There are various versions of it. You have Enterprise, that's pretty costly, has a lot of features. QuickBooks Pro, it's a step down. It typically fits what a business needs, and they even have an online version now. You pay a monthly fee, you can do your books literally anywhere in the world. So it's pretty nice. You just have to pick the one that suits your needs. what to key on when setting up QuickBooks. I'm going to get into the file because I think it'll be easier. Give me 1 second here.
And Joe, just so you can gauge time-wise, in like 7 minutes, we'll have to switch over
Okay,
or something like that. So I know you're used to a longer presentation.
No problem. So just a few things I want to point out in QuickBooks. When you're setting up a file, you basically, there's a couple things that I want people to key on. One, the chart of accounts is very important. So when you're doing QuickBooks, you have to enter in all your accounts. A lot of clients I see don't do this the right way, and it's integral as far as putting this information in, because garbage in is going to be garbage out, and if you don't talk to an accountant and set this section up the right way, you're going to have problems with your financials. There's no doubt about it. The other areas I want to just key on in here, and I'll speed it up a little bit, were under banking. I just had a client that dealt with this. They hadn't reconciled their bank account since July of 2008. So I got hired to do this, which was great for me because it was a decent bill. I charged them a good amount, it was fine. But it would have been a lot easier if they would have just done it. And he kept saying to me, hey, I'm all right with it because I have $10,000 more in my cash account than I have in my QuickBooks. So I have to have $10,000 sitting around somewhere. And I was like, you don't have 10 grand sitting around anywhere. It's probably you just forgot to record something. So basically, this function is key, and you go banking, and it's in my presentation, reconcile, you put in the ending balance, I'll just put in $10 here just for an example, and then it brings you to this screen, and you just check literally what's cleared and not cleared. And when this difference down here is 0, you hit reconcile now, you know if this is 0, you reconcile it. You picked up everything on your bank account. So everything that cleared is on QuickBooks, and you know you have an accurate balance. It's key. I just find this key. So many clients don't do it, and it's just such an integral step. So let me get back into the presentation in 1 second. Okay. All right, so that. Okay, now I want to focus on, real quick, and I skipped a couple steps in the QuickBooks, and you can refer to the presentation, but I wanted to focus more on as you grow, because I think this is also very important. As you grow, you can't really just rely on printing a QuickBooks financial statement. Banks are going to require you as you grow to basically use a CPA to issue a financial statement on your behalf, to basically say, we've looked at this client's financial statement and everything looks accurate. And I brought an example. It's actually a client we have. It basically breaks down into various types of engagements. But this is a client that we have. I changed the name and some of the numbers, but this is a reviewed financial statement. And it'll give you an idea how when a company starts out from nothing and is able to utilize QuickBooks, and then you go from QuickBooks and you have to say, I have to hire a CPA. The bank needs reviewed financial statements. Well, what does that mean? This is what a reviewed financial statement looks like. So basically, my company did this financial statement, but basically what it means is we go in and we issue a report that says we've looked at this client's financial statements and they look okay. Okay? The bank likes that a lot when we say that. So then it just moves on, and you have a balance sheet. You have an income statement. But the most important thing is where you get into the guts of the company, which a lot of people just miss stuff on. And the guts is all the notes of the financial statements. It talks about if you have a retirement plan, what type of, how do you recognize revenue, new accounting pronouncements, your property and equipment, accrued expenses, all your debt obligations. So as you move along with your business, keep in mind that a lot of people just sort of say, accounting is not worth it, I'm just going to throw it on the back burner, and I'm not going to reconcile my account, I'm done. If you grow and things go the right way, you're going to need some type of financing, whether it be through a bank or another investor or what have you. Odds are they're going to require an accountant looking at your books. This is something that you should really key on, is basically knowing that these are areas that literally lay out your entire business, and you're going to have to keep track of. So just as a heads up on that, okay? And then the last thing I want to key on is just I saw some tax tips the other day, and I thought they were sort of interesting because it was in a publication I subscribe to, and everyone always asks on the IRS side, what should we take the home office deduction? What should we, blah, blah, blah. And I always say to them, you can literally push it as far as you want, but you have to sort of be careful, And these were 4 areas that I read that I see a lot of small businesses dealing with. The first one, failure, it's self-explanatory. Failure to report all taxable income. You know, a lot of people don't do it. They get a 1099 as a consultant, they just forget to pick it up on their financial statements, and then that doesn't go on the tax return. The IRS gets the 1099s, you get a notice, okay? Home office deduction, I get that all the time. That is a huge red flag for the IRS. If they just see that Form 8829 in your tax return, they're gonna, more than likely, you're gonna get thrown into a bucket and potentially get audited. It's not worth it. Some clients say, well, I want to take depreciation on my office that's in my house. It's like $100. I say to them, it's not worth it. I mean, you're gonna get a notice, you're gonna have to pay me, it's just not worth it. So that's another key area just to keep in mind. Obviously, if you have a home office, you do deserve a deduction, but you just have to be careful how it's done. Schedule C, meals and entertainment. We all own businesses more than likely. We all take people out. It's deductible. You get a 50% deduction. Just don't go nuts with it. You know, don't put everything on there like you go out on Saturday and Sunday for 3 meals and they're all going through your credit card and you're picking them all up on your tax return. The IRS scrutinizes this area a great deal and it's a red flag. Last thing is business use on your auto. I mean, another typical question. I have a car. I use it for work. Can I deduct it, you know? Of course you could deduct it, but you just have to be careful what you're deducting. You can't just say, I use my car 100% for business. If you have that on the form, again, you're getting thrown into a bucket, the IRS is gonna scrutinize it. So you have to be careful. What's the right answer? Well, you know, use good judgment. That's what I always say to people. Don't say you used your car 100% of the time because obviously you have a personal life. You're not driving all the time for work. So that's just another area to key on when you're prepping your year-end returns. So that's it. Yeah, am I on time?
You're good.
Yeah, so thank you very much. All right, I'll rush a little bit in there, and I appreciate it. I'll take some questions
Just
after.
One question.
Yeah.
For the S corporation, do you issue, what was that, the K1 or 1099 to the...
K1. K1s are issued for both LLCs and S corps. That's what gets given to the shareholders or members. Okay.
Hey, Joe.
Yeah.
Is there a general rule of thumb for the meals and travel, like with respect to percentage of anything, or is that too much to ask?
No, it's definitely not too much to ask, and there isn't really a general rule of thumb. I mean, I think, you know, based on the revenue in the business, based on where you are from a taxable income perspective or loss, you know, if you're in a business and, you know, all of a sudden you had revenues of $500,000 and your M&E deduction brings you into a loss of $50,000. You know, I mean, it's like, come on. You know, I mean, what you're spending money on a business you're not even earning income on. So the IRS is going to say, I think you just have to sort of use that reasonable aspect. Yeah.
For the auto expense, I don't know if this is correct. This is what my accountant told me that you can either deduct miles.
Yeah.
Or you can deduct the actual payment if you've earned a business. So what would you recommend?
It depends. It really depends. If typically I use the miles route, just the standard mileage deduction, because it works out to be more of a benefit, okay? But it really depends. If you drive a ton for work, okay, and you're incurring a lot of expense, gas, whatever, you know, being the biggest one, it may make sense to move to the actual, you know, auto deduction method. You know, so it really depends where you're at. I mean, the standard, you know, the standard mileage method is a lot easier because you just sort of gauge a mileage and you just multiply it times the, you know, 50 cents a mile, and you're done. So yeah, it really depends. And the other thing is depreciation, and then I'll be done. It plays a key role because if you have a certain type of auto, you can take a big depreciation deduction, and that actually falls under the standard rate. So if you have like a big Hummer that you drive for work, I'm just saying, maybe you do, and it's over 6,000 pounds, you actually get a huge depreciation deduction on that, which it's not reflected in the standard mileage rate. So it'd be more beneficial to do the actual. Yeah.
And we'll be able to take some questions if there's time afterwards.
Sounds good.
For the entire
All right. Thank you, everybody. Appreciate it.
Thanks, Joe.